In today's video, we need to discuss everything going on in the market. Volatility is spiking across the board, and it has to do with employment data. We had a blockbuster jobs report that sent yields flying and caused real turbulence in the early session trade of the market, with small caps getting hit the worst. So today, we're going to take a look at seasonality and some hidden divergences going on in the market. We're also going to be having a look at some charts. The S&P 500 finally got its gap fill. There are some great charts and there are some worrying charts. So let's talk about it all together. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell and like this video. Let's get into it. So we're ending the week with a bit of weakness in a lot of the sectors that were the weakest in 2023. We're talking real estate, utilities, materials, most of consumer cyclicals. However, there definitely were winners. We saw the Mag 7, excluding Apple, really put out good days. And have a look at Tesla, 7.87%. So maybe that 185 level for Tesla sort of was like a fair value, at least what the market thought. Other than that, software, great day. Semis too. Same with financials. They continue to outperform. But if we actually go ahead and have a look at breadth, very, very mixed. 277 losers, about 230 winners. And this was a very weird day because the S&P 500 was up 1% for the day when there were more declining issues. And if we actually have a look at what those stats look like, so the S&P 500 after a daily gain greater than 1% with more declining than advancing stocks, the forward returns don't look that great. We've only seen this very few times. It's normally happened either at major inflection tops, as you can see right here, 2001, or major inflection bottoms, again the bottom of 2008 and I believe the bottom of 1987 right here. The two other times that happened sort of right after the COVID situation, and these are the returns we can expect on average 12 months later. The index is down about 0.7%, median returns down 6.6%. So just some very interesting stats for this Friday. Just something I thought I'd show you guys there. You know what would happen if we get like a ton of these days? That could be a little bit of a problem like it was in 01. But I think this is just one isolated instance, because if you actually have a look at where the majority of these took place, 2000, 2001, in a very short span. And this was in the tech bubble. Now, looking at the majors today, so Nasdaq, it was very thin leadership up the top. Nasdaq 100 stocks, tech stocks, software stocks, semiconductors. That's why the Nasdaq was up 1.72%. S&P 500 up 1%. If you actually have a look at the RSP, pretty much flat on the day, sort of down. This is the hallmark of very thin leadership at the top. The IWM was down negative 0.53%, and bonds took an actual dump today after the employment news, and we're going to talk about that a little later. Now, looking at the best performing sectors, communication services was the best sector today, undoubtedly, with what went on with Meta. A rising tide floats all boats. In distant second, semiconductors. But other than that, what you really want to have a look at these sector charts is what beat the SPY, what didn't beat the SPY. So the SPY was right here 1%, and you can see that almost everything underperformed the SPY. It was, again, thin leadership. What was very interesting though was industrials, manufacturing finally coming out of that recession. You could see right below technology, there was industrials, as well as regional banks right here making a bit of a comeback. The worst performing sector though, utilities, real estate, GDX. These names tend to be heavily levered with debt or gold, which just has an inverse relationship to yields as a whole. But let's talk about sentiment. We got the BofA Bull Bear indicator. It was at 6 last week, ticked up to 6.1. Now we got a bit of a note here from BofA, and I'm not going to read it all to you, but I am going to read the biggest picture. This is a very interesting note I saw from BofA. Bonds master, stock servant, except in bubbles and deflation. Yields down equals Nasdaq up big time in Q4, but script flip, Nasdaq up, yields up, first 4 week of 2024. Just goes to show that the big companies who aren't really affected by rates are running the show right now. Price action, Nasdaq up equals yields up first 4 weeks of 2024. Price action which occurs either post a recession or a bubble. Investors positioning for Fed cut / AI mania. Note, optimal strategy is barbell of bubble stocks and very distressed assets. So what are they saying? They're saying sort of hold the Mag 7 and then hold like undervalued whatever you can get your hands on. So that's a barbell approach. Probably hold bonds in there as well. But at the end of the day, bonds are dictating what's happening with this market right now. And the sentiment, as are all, exactly like I said last week, the sentiment is whatever equities you're in, hold. That is the sentiment at the moment. Now, let's actually have a look at BofA's equity sentiment. So equity sentiment ticked down 24 basis points in January, the first decline since October. And this is a note from Savita from BofA. She said the SSI, the sentiment indicator, the current level indicates an expected price return of 14% over the next 12 months, or 54.50 for the S&P 500 by year end 2024. So very, very interesting. So this green line here is extreme bearishness, bullish for stocks, and this red line here is extreme bearishness. And it's very, very weird. You'd think we'd be sort of in this area right here. BofA doesn't think so. Now, having a look at what corporate clients are doing versus what retail is doing. So if we actually had a look by clients, institutional investors led outflows, corporate clients led inflows. So institutions are selling, corporates are buying, retail is buying, hedge funds slightly buying. In total, big outflows, but really skewed towards institutional investors. So just some very interesting stats from BofA right there, that institutions this week are definitely net sellers of equities. Now, having a look at US equity risk premium, according to BofA, we're at 23-year lows. So this is the S&P 500 earnings yield minus the 3-month treasury bill yield. And according to BofA, we're sitting at about negative 2%. The lowest since 2000, but take this with a grain of salt. This is using the 3-month T-bill yield. I think it's far better to actually use the 10-year yield, especially if you're a long-term investor. And I do think the equity risk premium at this point is probably closer to like 2 to 3%, which is not great, but it's not bad, all things considered. That being said, if you had followed this trend for most of 2020 to 2023, sure, you would have had outsized returns in maybe like 9 months in 2022, but for the most part, you've underperformed bonds and credit as a whole. Now, looking at real Fed funds rate, guys, so this is the Fed funds rate minus the 5-year USD inflation swap rate. So essentially, the Fed funds minus inflation, and it's the highest in 20 years. So the cost of capital is very, very high. And I was actually doing some discounted cash flow analysis for like some stocks. Normally, I'd use like a 9% discount rate. Based on this, I was actually using like an 11% discount rate this week. And that was just to account for like what yields are doing. So yeah, the cost of credit is really, really high. And to be honest, I think the Fed should also be looking at metrics such as these when they do want to actually look at cuts later on in the year. Now, looking at ISM, guys, and we spoke about manufacturing. I said yesterday that we're coming out of this manufacturing recession. And according to BofA, the US ISM is likely to rise 53 to 55 by summer. Right now, we're sitting just under 50 right here. And we should see new orders increase, PMIs increase by 2024, and then leave this manufacturing recession. However, I do think what we are going to see in 2024 is a recession in commercial real estate. I'm going to talk about that in the weekend video. Now, moving along to the economy, roaring along. I showed you guys this yesterday, 4.2% Atlanta Fed GDP now. The economy is accelerating. Growth is accelerating in this economy. We also got non-farm, 353,000 non-farms. By the way, we actually had 167,000 revisions to this number. The number was actually like closer to like 500K if you include revisions. We had average hourly earnings 4.5%, beating consensus. Weekly hours did fall. Labor force participation came in as expected. The unemployment rate fell to 3.7. Average hourly earnings 0.6% increased ever so slightly. Now here's the breakdown. US government payroll jobs actually decreased. What does that mean? We got a lot of private sector growth. Look at manufacturing payrolls. They increased as well. So it wasn't just government jobs if you look under the hood of this jobs report. And if you actually have a look at it, private sector job growth was the majority of the job growth in this job report. However, even in the private sector, it's becoming increasingly narrowly driven with high touch services and low touch services, with goods producing not that great. But we will see that improve, especially as we come out of this manufacturing recession. And for the most part, high touch and low touch services encompasses most of the employment figures in America. And if we actually have a look at some more data from BofA, older generations' wage and salary growth is weaker than that of younger generations. Younger generations are making more money. That's really, really good. Look at Gen Z, look at millennials, as you can see right here. Traditionalists and baby boomers isn't getting the same wage growth as the younger people. And I think that's because a lot of these guys tend to move jobs a lot and to get pay increases as a result. Now, what did the jobs report do for yields? Now, looking at March, completely off the table. The market is trying to decide between a May cut and a June cut. According to BofA, we get the first cut in June, then we get another cut in September, then we get another cut in December, and this sort of follows the median FOMC. Now let's talk seasonal stats, guys. Very interesting stuff here. So this is February to December performance after a 10+% November to January. 13 wins, 1 loss, 14.4% gain. Only time we had a loss was 1987, simply because of the months October, November, thanks to Black Friday. Other than that very, very positive. And looking at the max drawdown, draw up, essentially what this is telling us that if we do get a dip such as this, or this, these are just buying opportunities because the draw up is very, very significant. Not just even double digits, high teens double digits, mid early 20s double digits, possibly even 30%. So looking at, longer term projections, 12 months out at figures like this is very, very constructive when looking past some of the near term volatility. Now let's have a look at earnings, guys. So not much happened today. We had Exxon and Chevron. Exxon a double beat. Chevron beat on revenue, increased their dividend by 7.8%. Other than that, not much to say. Crazy week of earnings, good week of earnings, all things considered. Now let's actually have a look at some of the mega caps because they all reported earnings except Nvidia, and this is the report card so far. Tesla was the only mega cap to miss EPS. Tesla was the only company to miss EPS, and it had a single day reaction of negative 12%. Microsoft, Google, Meta, Amazon all beat on EPS. However, Microsoft had a bad reaction. Google had a bad reaction. We know what Meta did. We know what Amazon did. Yet to be decided what Nvidia does. I do think that they're going to beat on EPS and revenue. Just depends what the single day reaction is, depending on what the street expects. That being said, this right here is very, very constructive for earnings as a whole because these contribute the most to earnings and earnings growth in the S&P 500, and to see them beat earnings is a really, really good sign, although I really wish Tesla would pick up its game. Now looking at S&P 500 as a whole so far, 72% of earnings have been above expectations, 7% in line, 81% above or in line. That's well above the historical average. And then below, only 21% of companies below. Now we still have quite a bit of earnings to get through, but that being said, the majority of S&P 500 companies have reported earnings, and earnings is looking actually pretty good. It wasn't looking so good when financials reported, but it's looking good right now. So besides the S&P 500, where can we find value? Well, I do think you can look internationally. Global EPS growth likely up 8% in the next 12 months. This is BofA's global EPS model, and it does look like growth is going to accelerate in those countries such as Europe, Asia, where it looks like we're sort of bottoming out in the really bad data. Yeah, the bad data is still coming in, but it's not getting worse. It's not decelerating, and that's a really good sign, and that's why BofA likely see 8% EPS growth in the next 12 months. Now, looking at earnings sentiment as a whole, this is essentially number of upgrades minus number of downgrades divided by earnings estimates over the past month. The best earnings sentiment is S&P 500 as well as Japan topics, right? Where's the worst earnings sentiment right now? Europe, and then emerging markets. And I'm sure like a lot of this has to do with like UK, Germany data, and then like China. I think if you were to remove those, probably see something very similar to a trend that's like that. Very, very similar to that. All in all, the sentiment is still towards America, and America's been the winner in the last 12 to 18 months. Let's just be honest about it. That being said, let's actually talk about Europe, right? This is the S&P 500 current earnings yield and Europe's current earnings yield. And Europe has never been this cheap before relative to the S&P 500. So if you go out and buy just the S&P 500 as a whole, right, you're getting just above 4% in an earnings yield. The 10-year right now is sitting at about 4.1%. If you go do the same in Europe, let's just say you buy the Stocks 600 index, you're getting about just above a 7% earnings yield. The equity risk premium there is skewed to the upside, and that's simply because European stocks have just been beaten down. And so Europe is definitely a place that you can find value. And if we actually have a look at the PE of Europe as a whole, 12.8, extremely good value considering you're getting 8% earnings growth. Now, essentially, think about that. Think about what happens in the market. Normally, we have price and earnings, right? The price increases, multiple expansion, and then the earnings follows. So if we do get a situation where multiples expand, earnings meet those expectations, we could really see a very solid run in European stocks for the next 2 to 3 years. Exactly what we saw in the S&P 500 throughout 2023 and now in 2024. We could definitely see that in Europe. Maybe not to the same degree, but if you're racking up 20 to 30% returns, just on an index, that's very, very good, especially over like a 2 to 3 year period. That's not bad at all. That's 10% annualized. Now, looking at other markets, Japan, it's very similar growth to Europe. We're looking at 8 to 10% over the next year, 15 PE. Whereas if you actually have a look at the US, again, we're expecting 8 to 10% growth too, trading at a 20 PE. What just looks objectively better? Japan, Europe, and you're getting some pretty big companies, well diversified diversified companies, especially across country and region. Now let's talk about gamma. So the call gamma resistance remains at 5,000 right here. Put support at 4,500. The gamma flip zone here at 48.45. So it is moving up, but that generally tends to happen when the market moves up. Now 5,000 is a very strong strike, and I do expect the market to go and touch that, get some price discovery at this psychological level. Huge amounts of gamma, call gamma, positive call gamma in this area, and I do think that this is going to probably continue to increase up until Feb OPEX. Feb OPEX is the 2nd of the 16th, but I do think in the environment we are right now, heavily skewed to positive gamma. Dealers buy dips, sell rips, and you should too, especially towards the 5,000 strike. There is a little bit of call gamma building here at the 5,100. Actually, not a little bit, a lot of call gamma building at the 5,100. And if earnings continues to surprise to the upside, the S&P 500 gets cheaper, stocks get cheaper. We're then going to go and have price discovery at 5,100. But for now, let's try and tag 5,000 level in the S&P 500. This is the psychological level as well. All in all, there's so much gamma right now, and especially as we're moving into the 2nd and 3rd week in February, which often is the strongest week for Vanna and Charm flow. So, week 2 of the month, and then OPEX week right here. And then maybe we can start looking for sells. And that coincides perfectly with February seasonality. We can definitely see here that the first 10 trading days tend to move higher. And then after the 10th trading day, sort of the 11th or 12th trading day, we do move down, at least according to February seasonality. Now let's hop on the chart. Now this is the S&P 500 index. The chart as a whole is looking very, very strong. I mean, under the hood, there is definitely a bit of weakness. We did see more declining issues, and I showed you guys the data this week. But that being said, we did try to pull back. Bulls couldn't hold us right here. And I said yesterday, this does look particularly strong simply because of the fact that if we do zoom in right here, we actually didn't break the low on this day right here. And we actually closed above the open of this red candle. What did we do? Gapped up and go. Quite a bit of sellers did come in at the top here, to be expected, to be honest. But we are very, very close to that 5,000 level, sort of right there, 20 to 30 points away, at least from the high of the day. And if we actually also have a look at the RSI, what this did was help us work off the overbought situation we had right here in the RSI. And if you actually have a look at this rally we've had, still not quite overbought. We're sitting right at the 70 level, and we can definitely, as you can see right here, here, and here, we can sort of like go into this area and just stay in it for quite a while. I wouldn't be surprised if we go ahead and hit the 5,000 mark, especially in the next 2 weeks in February. Looking at the Nasdaq, the S&P 500 definitely looks stronger on a technical basis. When you look at it, we actually did go and slightly make new all-time highs there in the Nasdaq 100. And here's the thing, if we continually see follow through in the Nasdaq as well as the S&P 500 like we have, what we're really just building is a high, then a lower high, then we're going to go make a higher high. And we actually kind of did. We wicked above the high. I can actually zoom in and show you guys that right there. See, we wicked just above it. What the market is telling us is that it wants to go higher. This price action is normally indicative of higher price action. If we actually have a look at TLT and look at what bonds did, guys, bonds were absolutely crazy. 3.83%, 3.66%, 2.75%. This is the 10-year, the 2-year, the 30-year. As a result, TLT bonds actually fell. They were down 2.1% on the day. And I just got some lines here. So this is a very strong level of support right here, and this is some very strong resistance areas. Now we did wick above the 97 area, as you can see right here. We are pulling back, but like I said, like I told you guys in the 10-year yesterday, I do expect us to trade in this range up until we probably get the first rate cut. The market is just doing a bit of price discovery to see where we're gonna go. Looking at IWM though, not looking good. The market is still trying to decide what's actually going on right here. I don't think anybody knows what's gonna happen with the Russell. Nobody wants to take trades above here. Nobody really wants to put sells towards here just because of the relative cheapness as well as the strength that's coming into the market. That being said, only down 0.61% when rates were up like 2.5%, the 10-year 3.6%. And if these do then just get crushed next week sometime for whatever reason, maybe we do see the Russell 2000 rally. But then having a look at the RSP, what I really wanted to see the RSP do was actually like follow through right here I wanted to see the RSP follow through higher on the week. Now, obviously, a lot of this did get derailed, but that's what I want to see the RSP do next week. I don't want to see like a topping form right here because this doesn't look too great. Sure, we did go break the high. It could be inspiring somewhat, but what I want to see the RSP go do is really push up and close in this area, 159, 159.50, maybe even the 160 area. Big ask, but sometimes you got to make those big asks. Now, looking at earnings next week, guys, not as big as this past week, but still a pretty heavy week of earnings nonetheless. We get some of these retail names, McDonald's, some of the industrial names, Caterpillar, huge following on Polanta. We get Eli Lilly. By the way, Eli Lilly is now a bigger stock than Tesla. I think we should start calling it the Exquisite 8 or kick Tesla out, add Eli Lilly. It'll be good to have a healthcare name in that index as well. We have Enphase, some of the solar names, Snap, Chipotle, Fortinet. This is actually a stock I've been looking at taking a position in for the long term. I might do a weekend analysis on that. If you guys want to see that, follow me below so you don't miss it. Uber reporting earnings, and then PayPal on Wednesday. Baba as well. I mean, Wednesday is a pretty big week. We also have Disney. Then on Thursday, we got some more payment names: Affirm, Cloudflare, Hershey's Chocolate, S&P Global. This is actually a fantastic company, by the way. Then Friday, we got Pepsi. Really want to see what Pepsi's earnings are going to do, especially because they've had pretty much zero organic growth, and all of their growth has come from price increases. Now, data in the week ahead, there's not much data, guys. One thing to do note is that CPI revisions and CPI is coming out next week. And then we have a ton of Federal Reserve speakers this week. But if you've made it up until here, guys, thank you so much for watching. If you like this video, subscribe and hit the notification bell. Like this video. Cheers.